on board Varun Lohchab from HDFC Securities also, who's joining in with us to discuss the market fundamentals and his top sectoral picks as well. Varun, good morning. Thank you so much for joining in with us. In terms of the market, we are amidst the earnings season. So overall for the Indian markets, given the geopolitical situation as well as earnings, what are you watching out for and what is the growth that you're expecting this earnings season?
Yeah, good morning. So earnings season this time around is largely on expected lines. We are expecting some more downgrades even in this quarter, largely led by IT and some of the global businesses, like global centric businesses. Domestics, again, domestic cyclicals are still not showing a very strong recovery. I think financials has started off well in terms of earnings season, so that out there we are seeing some marginal upgrades to our estimates. So net, we believe, this year, FY26, we are expecting around 12% earning growth, which is not, I would say, really strong, but better than last year. And there are still some marginal risk to the downside on the earning estimate, but I think the pace of downgrades is definitely reducing. So Q3 and Q2 had very sharp downgrades. Q4 would be a tad lower. And we expect by Q1 we'll be largely done with the downgrades.
Do you have you done the analysis so far in Q4? What's the upgrade downgrade ratio looking like, or the percentage of overall downgrades? And where is it that we've seen maximum pain?
See, so far only 50 stocks out of our coverage of around 240 to 50 stocks have reported. So in that, as I said, financials have generally done better than what we were expecting, and IT, despite we cutting numbers in our preview itself, have seen further downgrades. So I would say, and cement has done better. So those are some of the pockets. Consumer is still on the weak side, but a lot of the numbers are yet to come. So net, I would say as of now, it would be even Stevens, like, 50% in terms of upgrade, downgrade, with banking leading the upgrades and IT leading the downgrades.
Okay, banking leading the upgrades, IT leading the downgrades. But, right now, what sectors will you look at to buy also as of now? Financials, will that be something that you'll keep looking at? Or maybe, where you're seeing a bit of a correction, pharma, IT, that is also something that attracts you?
I think, the market are not, at a stage where you can expect a very high return at an aggregate level. So in that sense, a lot of frequent rotation will continue to happen even in FY26. That's our view, because valuations are really capping the upside at an aggregate level. At the same time, the downside also beyond 22,000 look unlikely unless we have some really major earnings cut event, either led by global developments or the domestic developments. But as of now, we are not seeing a level below 22,000 either. So in that scenario, we have been having financials as one of our top picks for last 6 months. We were progressively adding that, and we were underweight IT. That has played out to a large extent. While we still continue to prefer financials over IT, but I think IT with the recent correction and financials with the 20% kind of an up move are now looking more balanced in our view. And if there is some more financials rally, then we would be taking money off financials as well, because it's not that financials are going to have a very strong earning growth in FY26. So it's a sort of a range bound market with more rotations and frequent rotations across some of these sectors. Beyond these, I think pharma, as you said, we are still positive, but both IT and pharma, we had cut our weights because they were the only performing sectors last year when domestic cyclicals were under pressure. And in fact, we had added some exposure to domestic cyclicals, both industrials, real estate after the correction, and even consumer discretionary. So those are the other two pockets, some of the consumer discretionary and industrials, real estate sort of segment where we have added exposure. And IT, pharma, if they correct a bit more, we will be looking to add them back.
You said in financials, if they rally a bit more, you would look to trim your positions. So about a 5-10% rally from here on, and then you would look to unwind in which stocks? Which are the stocks that you hold right now where you think, which are prime for profit booking?
See, I think some of the large NBFCs, they have already done well, and now again valuations are starting to look full. Some of our, we had gotten quite positive on both Bajaj Finance and Chola. While we still have positive rating, we don't have much upside left on our target prices now in those two stocks. Similarly, some of the large private sector banks, while we continue to like ICICI, Axis and all, but I think the extent of upside left now is a tad limited. So even Kotak Bank, for that matter, the upside left now on our target price seems to be on the lesser side. So some of these would be the names where we would be willing to take profits if they rally further.
Okay. Varun, what is your thought coming in on the broader end of the markets? While you did say some of the sectors that you like and you listed out those sectors, but is it more on the large cap side in these sector names that you would look, or would it be more on the mid and small cap side?
I think mid and small cap this entire year, calendar year, we believe are going to underperform the large caps. Valuations are still on the higher side, especially in mid cap, not so much on small caps now, but small caps are anyway struggling for growth in this sort of an environment when neither the domestic growth nor the global growth is too supportive. So we are looking for more ideas in large cap because I think the margin of safety, even from a valuation perspective and resilience of growth perspective, is better in large caps. Mid and small cap, very selective. So some of the selective mid cap where we are quite confident on the medium term growth out there, we are looking to add on dips. But otherwise, generally preferring large caps. We expect mid and small caps to continue to underperform this year.
Okay, and your thoughts coming in on the real estate side. Last 6 months, we've seen a bit of a correction coming in for these real estate names. Would you stay away from these names, or would you look to enter real estate right now?
No, so this is one of the sectors which we are looking to add in this correction because on the numbers we are quite confident that we'll continue to see robust residential sales even in FY26 and 27. We don't believe we are at the end of the rally, while obviously from COVID lows you have seen very high pre-sales growth for some of these developers. That will not continue, but still it would be a healthy number and there would be a YOY growth. Valuations had gone through the roof 6 months back, but now with almost 30 to 50% correction in a lot of these names, some of them are looking attractive. So we see this more as a consumer discretionary segment where we are confident on medium term growth and therefore looking to add some of the names in the recent correction.
What would you look to add, if at all, in IT? Would it be the ER&D companies which have fallen 35-40% from their recent highs? Would it be the IT services companies where the free cash flow yield is now looking attractive, but growth is missing? Where would your preference lie?
So for last 6 odd months, our preference was for large cap IT over mid cap IT because valuations were looking stretched out there. While mid cap IT, obviously some of the names have been doing exceedingly well in terms of growth. We believe the valuation premium they were enjoying is a bit on the higher side. So I would go with large cap IT where there is some valuation support of free cash flow yield coming in with this correction. Our first sort of point of entry would be out there because we believe the growth rates even for some of the mid-sized companies which have done exceedingly well will also slow down in this environment, and therefore it's better to have some margin of safety in valuations in this sector given the sort of uncertainty we are in terms of the top line growth.
Mm-hmm. Varun, just the last word from me is what I want to understand in terms of overall macro indicators. When you look at some of the points coming in, industrial output, credit growth, some of the trends in terms of inflation seems to be like that the worst is behind. Is that the case? And for the rest of the year of FY26, what is the overall growth that one could expect or pencil in terms of earnings?
Yeah, so as our house view has been that the macros have definitely bottomed out. What we saw in Q2 in terms of the GDP growth and inflation at that point of time, they were probably the worst, and incrementally things are getting better. Be it growth, be it inflation, be it the interest rates, be it the RBI sort of stance in terms of providing liquidity and cutting interest rates. So therefore, the downside to the market is limited, but at the same time, the upside, because we are still not in a high growth environment. Our GDP growth this year would be close to 6.3. Next year will not be substantially higher. So in that sense, earning growth, as I said at the beginning, would be, right now we are penciling in around 12%. And if you ask me, the chances of it becoming 10% are higher than chances of it going to 15, 16%. So therefore, your upside gets capped. The moment you have a 10% kind of a rally, the way we had in April itself, your upside start getting capped. At the same time, the downside, the 22,000 level, we have seen that a lot of stocks start getting attractive once they come around those levels. So I think it's going to be a range bound market for another 6 months before we either, by that time, if we remain range bound, then valuations will become even more comfortable, and growth, we believe, will incrementally pick up more in second half of FY26.
Okay, markets range bound for the next 6 months. 22,000 is is perhaps the bottom for the markets in the near term. Thank you, Varun, for joining in. We'll get into a break. On the other side, we'll talk commodities. Manisha Gupta joins in on the other side.